Remarks have three parts to them. Part one is just an assessment of current economic conditions and the near-term outlook. When I say near-term, I mean the next 12, 18 months, let's say the end of the decade. And they're pretty good. The economy is strong. The U.S. economy, the global economy, they're doing very well, and that should remain the case at least through the end of the decade. Once you're feeling really good, we'll go to part two. Talk about what could go wrong. Brexit's a pretty good example of something that might go wrong. I'll give you a few others. So what could derail the train over the near term? And then, part three, I'll tell you when the next recession is going to happen and what's going to cause it. And if everyone have a pen? I'm going to give you the exact day. Yeah, the exact day. Does it sound okay? Okay, all right. Part one, the economy is doing very well. Pick your statistic. Actually, Moody's Analytics works with a human resource company, ADP. We collect data on 28 million employees across the US every month. And based on that, we construct an estimate of employment growth. And just because we want attention, we do that 2 days before the Bureau of Labor Statistics puts out its statistic. And we put it out yesterday. It was a great number, up 230,000 jobs. And I noticed CNBC blamed us for this run-up in long-term interest rates. You saw the rate jump. It says because of that strong report. It is a strong report. 230K is a lot of jobs. We're creating lots of jobs. We're on track to create 2.5 million this year. That's what we created last year, the year before. When you're creating that many jobs, you're creating all kinds of jobs. Low-paying jobs for sure, leisure hospitality jobs. Middle-paying, construction, manufacturing. High-paying, financial services, professional services. There's really only two sectors that are not adding. They're struggling a bit. The first is brick-and-mortar retailers. No surprise, Amazon's killing them. Did you see yesterday they announced, was it yesterday or the day before, Amazon announced that they're going to lift their minimum wage to $15 an hour, so that's double the national level. Mortgage banking. The run-up in mortgage rates is now doing a bit of damage to the mortgage market. Refinancing activity is dead. But other than that, jobs everywhere. The current rate of job growth, 2.5 million, that's double the rate of growth in the labor force, the number of people coming in looking for work. And that means unemployment and underemployment continue to decline. The unemployment rate is now 3.9%. Probably a fall on Friday when the BLS tomorrow comes out with its statistics, probably fall again. But 3.9%. You can see here, there are now more open job positions out there than there are unemployed workers. That's the first time that's happened in the period over which we have data. So that's quite an achievement. The labor market is getting tight. If job growth, the economy remains strong, sticks to script over the next 12, 18 months, the U.S. unemployment rate is going to get pretty close to 3% by the end of the decade going into 2020. There's only two other times in American history the unemployment rate got that low briefly. The first time was in the middle of World War II. The second time was in the early 1950s. Anyone remember what happened in the early 1950s? The only reason I know this is because I just finished a biography of Harry Truman by David McCullough. Anyone ever read that book? Don't read it. Don't read it. Yeah, I'm one of these guys who, once I start a book, I can't read anything until I finish that book. It's been 3 years since I've read another book. So it's like really painful. I mean, it's interesting, but how much do you want to know about the Harry Truman Library, really? I know everything, by the way, about that library. Why was I bringing that up? Oh, the early 1950s, the Korean War. We had 10% of the American workforce overseas fighting. So we've never been this low on unemployment in peacetime. Very, very unusual, rarefied territory. Now the good news is with this drop in unemployment, wage growth is picking up. There's been a lot of debate among economists about wage growth. Why hasn't it picked up? It's picked up. Plethora of wage statistics. So if you look at the plethora of wage statistics, wage growth now is about 3% year over year. That's double what it was if you go back 3-4 years ago. And if everything, if unemployment continues to decline as I expect, wage growth will continue to accelerate. 3% is about where you'd expect it. That's 2% inflation plus 1% productivity growth. If you remember back to Econ 101, wage growth should equal, real wage growth after inflation should equal your growth in your marginal product. That's productivity growth. So 3% is about right. But we'll go above that. And that means that businesses are going to have some real pressure on profit margins going forward because wage growth will outstrip productivity gains, and that'll start cutting into margins. So we'll see some pressure there. They'll respond by raising prices, so inflationary pressures will probably develop as well. But wage growth is picking up, and the good news is that low unemployment, falling unemployment, lots of jobs, broad-based job growth, accelerating wage growth. That means the American consumer is going to do their part. They're going to go out and spend. And as long as the American consumer is spending, we're good. We drive the train, not only the U.S. economy, but because we have a $500 billion annual trade deficit, we drive the entire global economy. So if the American consumer is spending, we should be in pretty good shape. The other reason for some optimism about the next 12, 18 months is, in terms of growth, is there's a lot of fiscal stimulus, a lot of juice out there. We passed tax cuts at the end of last year. There's a big piece of legislation that started this year to raise government spending, military spending, and non-defense spending across the board. All deficit finance, so we're we're going out borrowing lots of money. The budget deficit is rising very rapidly, and we're cutting everyone a check, and so that's juicing things up. That's one reason why the retail environment's so good at the moment. And that juice, that fiscal stimulus juice, that's going to be there through this time next year. Then it goes away, unless there's another piece of legislation that cuts taxes further and we go out and borrow more money, which is possible. It depends on the election, right? So if the Democrats win the House, and that's the betting at the moment, that's my baseline. By the way, I'm not very good at predicting elections at all. I got the Clinton-Trump election dead wrong. I had a model. I thought it was great. I got every election exact, electoral college model, maybe I overfitted, I'm not sure. You can see this is really bothering me. Of course, I didn't have a Russian meddling variable in the model. Might have made a difference. But I got that election wrong. So I could get this election wrong too, but I'm assuming that we get a divided government, and if we do, then there will be no other additional economic policy done in the next 2 years, and we won't get any additional stimulus. If the Republicans do maintain control of government, then probability is pretty high we get another tax cut, and so that'll extend out the stimulus. There will be a day of reckoning. It just won't be, going into 2020. It'll be a little further down the road. But for the next 12, 18 months, it's going to feel rip-roaring out there. It's going to, best of times. It's going to feel really good. And if you're not looking any further out, you'll feel pretty good. How are you feeling? That's the pinnacle right there. Okay. Sorry, I'm an economist. Yeah. All right, part two, what could go wrong? Well, there's a lot of things. I'm not going to dwell on the American political situation. Obviously, things could go off the rails there. I'm not going to talk too much about Brexit. That definitely is a big deal for the UK. They're going down the rabbit hole, and probably take the EU with it if don't come to terms. I mean, I think everyone knows the gun's at the head, and that means that we get a deal. I saw in the FT this morning, there seemed to be coalescing around the idea that the UK will remain in the customs union, which makes a whole lot of sense, and that's probably the compromise here. But obviously, that's a deadline, March of next year, and we've got to watch that. There's the Iranian oil sanctions. I don't know if anyone's been following that. Oil prices up a little bit in anticipation. They will be imposed at the start of November. Depending on what the Trump administration decides, that could be a risk. If they really go put the hammer down on everybody, Europeans, and say you don't take Iranian oil, that could be a problem. Saudis can't fill that, but I don't think that'll happen, but that's a possibility. So let me focus on 2 or 3 other risks that threats that could derail things. The first and most immediate is the trade war. It's not over. Actually, I was in Canada 2 days ago in Toronto, and Canadians are breathing a sigh of relief. Got a deal. Not that this deal with Mexico and Canada changes anything. It's exactly the same deal as we had before. I mean, we blew up NAFTA and then we put it back together again, and in the process we made everyone mad. And nothing has changed. Nobody's expectations for jobs, GDP, anything has changed as a result of the deal. But if there was no deal, that would have been a problem, right? That would have been pretty disruptive. There was a bit of a relief rally in equity markets as a result. But now the trade war is solely focused on the relationship with China, and that could be a big deal. My working assumption here, and I think this is the assumption investors have, is that if the trade war gets to a place that it's actually doing some visible damage to the equity market or to the broader economy, it's showing up in the data, that President Trump will end the war, declare victory, move on, put his hand over here and say, look at this, and we'll go look at that, and we move on. That's the working assumption. But there's a lot of risk around that. These are strong personalities that are involved. We can get easily into a kind of a prisoner dilemma situation, and this thing can go off the rails. And if it does, it could have implications. You can see here what happens with the effective tariff rate if all of the tariffs that the president has threatened actually are implemented. We go from an effective tariff rate before all this of 1.5% to close to 5%, and you have to go all the way back to World War II to find a tariff rate that is high as it is today. And also the Chinese aren't going to stand still. They're going to respond, right? They can't respond in kind. The U.S. imports $500 billion worth of stuff from China every year. The Chinese import $150 billion of the stuff we export to them every year, so it's not balanced trade. So they can't respond in kind, but they could respond commensurately by doing other kinds of things. Devalue the yuan. It can make life difficult for companies that do business in China. You know, Moody's, for example, does a lot of work in China. They can make life very difficult for us. They could even say to the Chinese people, don't buy an iPhone. Can you imagine that? What would happen to the market on that day? That would be a pretty tough day. And the market wouldn't be down for a day or two. It would be down for a month or two, you know, if that happened. So they could do a lot of damage here. And I don't know if we get to the place where it actually pushed the U.S. economy into recession, just given all the fiscal stimulus in the economy, but definitely something to consider. Certainly a risk. It changed the contours of the economic outlook. One other risk I want to mention, and that is interest rates. They're going up. You can see that in the market action over the last couple of days. The long-term interest rates are rising. Short-term rates are going to rise as well. The Fed's normalizing interest rates, monetary policy, number of different ways this could happen. You can see the different forecasts here. The Fed's forecast is the red line. This is the funds rate target. So every quarter they publish what's called a dot plot. The forecast of the funds rate given by different people that on the FOMC that make rate decisions. And this line represents the middle of the distribution of those expectations. So we get one rate hike in December, another rate hike in December, quarter point, 3 rate hikes next year, and then for some reason they are going to pause in one quarter. I'm not sure how you get there, but that's their forecast. And then one in 2020 in the long run, or the terminal rate in the long run is about 3.5%. You can see my forecast. That's the green line. I expect 4 rate hikes next year. Again, I have a hard time getting my mind around why you would, pause under. Maybe if there's a financial event, you might pause. I'm not sure. And then you can see the line starts to decline later in 2020. That gets to part 3, the next recession. So kind of presages that. Look at the blue line. That's the funds rate forecast implied by futures market. So you just go into futures market and you pull out what markets are anticipating. This isn't quite apples to apples, right? My forecast, the Fed's forecast, is kind of in the middle of the distribution. The blue line is kind of a probability-weighted distribution. So if markets are down or attaching a higher weight to darker scenarios, you could see the blue line migrate lower. But even abstracting from that technical issue, there's a pretty large gap. The market's expected December rate hike and then maybe 1 or 2 next year, and the terminal rate is 2.5%. Somebody's wrong, right? Somebody's wrong. It's not me, it's the markets. That's going to close. That gap's got to close. And in my baseline optimism about the economy, I'm assuming that that this adjustment will be relatively graceful. And so far, it has been pretty graceful. I mean, the markets are adjusting. They have been marking up expectations. Markets have been wrong. Their forecasts have been wrong over the last couple of years, and they've been marking up. And we've seen some volatility in markets. But it's been relatively modest and very digestible. But the risk here is that we see a lot more volatility in markets, which is entirely plausible given how highly valued markets are. Equity prices are pretty high by any measure relative to earnings or anything else. Cap rates are pretty low. Credit spreads are pretty narrow. So markets feel vulnerable. So it's possible we get more volatility here and it does more damage to the economy. But that wouldn't be my baseline. So the next 12, 18 months look pretty good, but there are some meaningful threats out there. Okay. That's part 2. All right. Ready? Part 3. The next recession. Okay. I'm looking at, there are a lot of familiar faces in the audience. Joe just saw me speak. Was I better 4 months ago than I am today? A little bit better? Yes. Oh, I always hit it, yeah. I was at USAA, and I told them the recession date, and Joe's waiting for the update. The best long leading indicator of recession is when the economy goes past full employment. Now, there's a lot of debate, reasonably so, about what is full employment. Economists focus on the unemployment rate, and the consensus view, the view Congressional Budget Office has, my view, Fed's view, is that the unemployment rate consistent with a full employment economy is 4.5%. Now, we say that with a lot of precision, but it's give or take, but around 4.5%. Remember, we're at 3.9. We're at 3.9%, 4.5%. So what happens is when the economy goes past full employment, by definition, tautological, it has to go back to full employment, right? Because if it doesn't go back to full employment, if that's the right number, 4.5% is the right number, the economy overheats. Wage pressures develop, continue to develop, inflationary pressures, margins squeeze, businesses respond. Moody's always raised prices no matter what, but we will start raising prices more because our labor costs are rising. Sorry, guys, I'm just, I'm the economist. I can say whatever I want. And the economy overheats, so it's got to go back, right? So the problem is, once unemployment, no matter how low unemployment is, once it starts to rise, you run the risk of getting into a self-reinforcing vicious cycle, right? Unemployment rises, people get a little nervous, they pull back on their spending a little bit, businesses recognize that, they stop hiring as aggressively, unemployment rises a little bit more. You go from a world of where we are today, a virtuous cycle, to a vicious cycle, And in fact, at this point in the business cycle, when that happens, kind of the metaphor everyone starts talking about is, can the Federal Reserve, can the central bank soft land the plane? What that means is, can the Fed engineer interest rates higher in a way that gets the economy to get back to full employment without actually crash landing, without actually going into recession? Well, it never has. It never has. Maybe once in the late 1990s, in the tech boom. It's very difficult to pull that off. The other thing is, the further the economy blows past full employment, the more difficult it is to soft land. It's like you're trying to land a plane coming into the tarmac at 250 miles an hour, right? If you're well past. And I just made the case, and I think a very strong case, that the unemployment rate in late 2019, early 2020 is going to be close to 3%. So we're at 3%, and full employment unemployment rate is 4.5%. The unemployment rate has got to rise by over a percentage point. Try to land that plane. I don't know. It feels really tough. That's going to be a very difficult thing to do. Here's a factoid. You know what a factoid is? Actually, I did say that on CNBC, and they roasted me because I didn't know what a factoid. It sounds good. Factoid is a very interesting fact. It's a very interesting. It is a fact. It is a fact. The average length of time between when the economy goes past full employment to when the recession hits is 3 years. 3 years. There's a pretty large standard deviation around that, but on average, 3 years. So here we are. The unemployment rate passed through 4.5% in the summer of 2017. The U.S. unemployment rate fell through 4.5% in the summer of 2017. So summer of 2018, summer of 2019, summer of 2020. Summer of 2020. Here's the second best long leading indicator of recession. That's the yield curve. Yield curve is the difference between long-term interest rates and short-term interest rates. A lot of ways of measuring that, but my favorite way is shown here. This is the difference between the yield on the 10-year bond and the 3-month bill on an equivalent bond yield basis. And this is just the difference. I'm showing that difference, the shape of the yield curve back into the mid-70s. You can see when recessions occurred. Those are the red shaded bars. And the immediate thing you'll notice is every recession has been preceded by the so-called inversion of the curve. That is, short rates rise above long rates, the Fed tightens, ultimately short rates rise above long rates, the curve inverts. It's normally positively sloped, it inverts. And the other thing you'll notice is it never has falsely predicted recession, right? It's foolproof, right? Third thing you'll probably notice, that dotted line is just the current spread. It's about 100 bips, and generally, not always, the 1990s was an exception, generally, when the curve gets this narrow, 100 bips, less than 100 bips, it goes on to invert. And I think if we meet here next year and Damien invites me back, if everything is sticking to my script, the curve will have inverted by that point in time. The other thing you'll note, the average length of time between an inversion of the curve by this measure and recession is 1 year, 1 year. So if the curve inverts this time next year, that would say mid-2020. The intuition behind this is pretty straightforward. A financial institution, banks, many of you, can't make money when the curve is inverted, right? You fund yourself rates and you lend out at long rates. And when the curve is wide, your net interest margin is ample and you're making a lot of money. When the curve flattens and goes and inverts, your funding costs are greater than your lending rate. You can't make money. And if you can't make money, you won't extend credit, or you become tighter on extending credit. And credit is the mother's milk of economic activity. Too much credit's a bad thing, obviously. You get financial crises. But not enough credit's also a bad thing, right? Because you need the credit to drive the train. It's the fuel that drives the train. So this is the intuition behind it. There are two necessary conditions for recession. Condition number one, the economy overheats. And I think I've made a case that the economy is headed in that direction. It's not quite there yet. Inflation is still low. But it'll pick up. It is already picking up. And with wage growth accelerating and growing above the rate of productivity growth, margins will compress and businesses will respond by raising prices. So I do think the economy risks overheating. And again, if you believe in the full employment rate of 4.5%, that's going to happen. The second precondition for recession is to be some major imbalance in the economy that's mirrored in the financial system. The best way to explain that is by example. Go back 10 years ago to the Great Recession. That's pretty obvious, right? The imbalance in the economy was housing and subprime mortgage, RMBS. There's a slew of problems back then, but that was at the core of the problem. 2000, 2001, that was the internet boom, the equity bubble. Stock market feels stretched today. It was significantly more highly valued. You had we have real companies today, and Amazon and Apple and Netflix. Back then, we had a company called Economy.com back then. That was the firm I started. It was a real rock solid company that Moody's acquired. But then we had Pets.com, that kind of thing. Then you go back to the early 1990s. That was, you may not remember, but I remember that pretty well. That was junk corporate bonds. Remember Michael Milken? What was his firm? Drexel Burnham Lambert. And then CRE, commercial real estate, and the S&L crisis, obviously. And I can go back to every recession since World War II, ex post, and identify, at least in my view, what drove the economy into recession. Harder to do ex ante, but I'm going to try, okay? First, I'm going to say, here's what I'm not worried about. I'm not worried about household debt credit. I think there's some things that get on my radar screen like subprime vehicle or retail card, but they're too small, and the consumer lenders, mortgage lenders are pretty sensitive. They remember 10 years ago, and they step on the brakes as soon as it looks like credit quality is eroding and we start to see higher delinquency rates. And they have. Student loans, that's a corrosive on the economy, obviously. It makes life very difficult for millennials. They're going to buy their first home a little later than their parents did. They'll start companies later. When I started my company, I was 30 years old. I didn't have any student loan debt. So if I had student loan debt, that might have been more difficult. But that's a taxpayer problem. 1.3 trillion in student loan debt outstanding. 1.1 trillion is government backed. The other 200 billion is pretty good, co-signed, credit underwritten, graduate students who are going to make an income. No problem. So that's not the issue. We might want to worry a little bit about the fiscal situation. The deficit is now ballooning. We're going to have $1 trillion deficit in the coming year. Debt loads are rising. Municipal finances are in pretty poor shape. Although there's a lot of fiscal space there, and municipal, federal government have a lot of room to maneuver, so I don't think that's it. That's another corrosive on the economy, but I don't think that's what's going to do us in. So what's going to do us in? I think it's going to be corporate lending, non-financial lending to non-financial corporates, highly levered companies, so-called leverage lending. Just to give you a sense of it, I don't know did I give you? There might be a chart here. No chart. Sorry. I have a great chart. It shows the amount of leveraged loans outstanding. If you go back 5 years ago, it was 800 billion in outstanding. Today, it's 1.4 trillion in outstanding. Half of all the leveraged loans that are originated, these are commercial, industrial loans made to already highly levered companies. That's all a leveraged loan is. Half of all the leveraged loans go to so-called CLOs, collateralized loan obligation, right? And I was just looking at, we have very good data on this market because we rate all of this stuff. And August of 2017, I'm speaking from memory, so I don't have it exactly right, but this is pretty close. August of 2017, there was $480 billion of CLOs outstanding. August of 2018, I don't have the September data yet. August of 2018, $630 billion. You know that old banking adage? If it's growing like a weed, it's a weed. So there's problems there. The other interesting thing is, I said half of all leveraged loans go into CLOs. The other half go everywhere else, lots of different investors. But no one has a grip on that. The other $700–800 billion that's in the non-CLO part of the market. Even Moody's, market doesn't have it. Reuters doesn't have it. I think we have it somewhere in the bowels of MIS, but no one has really put that in one place that anyone can take a look at. Now, there may not be a problem, I don't know. But it's one of those things that, this is the shadow system, very opaque, and it makes me very nervous. So if I had to put my finger on something, that would be it. One other interesting factoid, there's $1.3 trillion in junk corporate debt outstanding. When you're a business, you can either get a loan or you can issue a bond. So both different ways of leveraging, they have different characteristics. Right now, lending is more favorable than issuing a bond, but add them together, $1.4 trillion in leveraged loans, $1.3 trillion in junk corporate debt. That's $2.7 trillion. At the peak of the subprime mortgage market, there was $3 trillion in subprime mortgage debt outstanding. Now, I don't want to draw too close a link. The CLO market is not the RMBS market. Very different markets. The structures are very different. So I don't think this is going to infect the financial system. I don't think they're going to blow up, CLOs are going to blow up like RMBS did and take out the financial system. We're not going to have that kind of an event. But I think these companies are going to be under some significant financial pressure when interest rates rise. These loans are adjustable rate. When the economy actually does slow going into 2020 because there's no more fiscal stimulus. And these companies are going to struggle to make their debt payments, and are going to respond by reining in their hiring and expansion. So if I had to put my finger on it, that would be it. That's the concern. Now, obviously, the interesting thing is once you people start identifying the problem, then that won't be the problem, right? Regulators will respond. We'll get guidance from the Fed. Countercyclical capital buffers will be increased. So maybe that's not what it is. But right now, at the moment, that's what I would put my finger on. So when's the next recession? Ready? No one's picking up their pen. June 20th, 2020. Why? It's the solstice.
Mortgage rates. Where do you think they're going and how fast?
He's asking for personal advice. He wants to
Exactly.
know where mortgage rates are going. Well, for context, the 30-year fixed rate mortgage, and this is prior to this recent 25 basis point run up in 10-year yields, was at 4 3/4. So with the 10-year with the rise in 10-year yields, let's say they stick, and I think they will. That means that the 30-year fixed rate loan is going to be close to 5%, say, in the next couple, 3 weeks. That's up from 4%, under 4% a year ago. So we've seen, if I'm right, that's a 100 bip increase in mortgage rates in a year. And that is doing some damage. I don't know if you've noticed, but the housing market's kind of gone sideways here. Particularly in this part of the country, places where homeowners rely heavily on tax deductions. New York, New Jersey feasted on the tax deductions that were taken away. And so we are starting to see some real weakening in sales and house price growth in response to the higher mortgage rates. In the long run, when 10-year yields are where they should be and where consistent with a full employment economy, inflation at target, given current G fees charged by Fannie and Freddie and the FHA, VA, the 30-year fixed rate loan should be, somewhere around 5.5%. So we're still not quite where you'd expect them to be in what I would call equilibrium. So right now we're at 5. If you told me we get to 5.5% at some point over the next year or two, I'd say that sounds about right. I do think, though, again, the yield curve is going to all rates are going to rise, but the yield curve is going to get flat, so short rates will rise a lot more than long rates. So we're not going to go much above 5.5%, I don't think. But 5%'s done a lot of damage. I mean, completely took out all refinancing activity, right? Because the bulk of mortgages outstanding, residential mortgages outstanding, have a coupon of 4%. So if you go much over 4.25%, 4.5%, the only reason you refi is because you want to try to take cash out, and that's a relatively small part of the refi market. But that's going to hurt. Did I answer your question? Yeah, great. We might get a little lucky. Maybe the administration decides to lower G fees on, get the FHA premium down and the GSEs to lower their. Although you look like a wealthy guy, you'd only get a jumbo loan, so forget about it. Yeah. He wanted to know, will the Philadelphia Eagles win the Super Bowl this year? I am a Philly boy. We've gotten off to a tough start. You didn't ask that, though. No. Okay. Deficits and debt. It's like, how I view it? It's like climate change, right? We know climate change is a big problem. We don't know how big and when it's going to do us in, right? But if we don't do something, we're toast, literally, toast, So that is the deficit and the debt. It's like a problem. We know it's a problem. It's already costing us. Hurricanes are happening, right? The sea level is rising. It's doing damage, and we're having to invest and work around it, and that's what we're doing. Exactly what's happening with deficits and debt. One reason why long-term interest rates are up 100 basis points is, the economy's strong, but it's also because everyone recognizes we're going to have trillions of dollars of more borrowing out there to pay for the tax cuts and the spending increases. So it's a corrosive on the economy. But when is it? It's not a cliff event. It's a corrosive. Now, economists are doing a lot of work trying to understand, where is the cliff? Because other countries in the world that aren't as lucky as we are, that don't have a reserve currency, don't manage their own currency, they can go off the cliff a lot faster. So economists have used that information to try to figure out where's the cliff for countries like the United States of America. And I've tried to do that. IMF does really good work there, and I've actually extended their work using EDFs for banks, across that's another thing that we construct that's very useful. You know, my best sense is the cliff is a long way off. So right now the debt to GDP ratio, publicly traded debt to GDP ratio is 80% going to 85% over the next few years. The cliff is 250. So we got a long way to go. Not that, that's like climate change though. I mean, the problem is 50 years from now if we don't do something, the same thing with the current trajectory, if we don't do something, we're going to be at 250% of debt to GDP ratio, we're going to have a problem. So we got to do something. Unfortunately, it's not my problem. I'm out of here. So thank you very much. Thank you.